Mortgage holders, markets and economists are waiting to find out what the Reserve Bank has decided to do this month on interest rates. For the first time in nearly a year, there is debate about what the central bank will do. Some believe the bank will take a breather from its relentless rate rises. The cost of borrowing has gone up for the last 10 months in a row, while others think rates are heading higher again. We're standing by to bring you that decision with our usual team. Dan at the Reserve Bank in Sydney is our business editor, Peter Ryan, and with me in the studio is our finance reporter, Alicia Barry. Hi, Alicia. To you first of all then, it is the first time for a long, long time, isn't it, that there is some uncertainty about what the Reserve will do?
Yeah, that's right. I mean, Philip Lowe, the governor of the RBA, flagged in early March that the bank was considering a pause at some point, and that was reiterated in the March minutes that at that board meeting they did consider a pause might be likely or necessary in the future. And this is the meeting that it could happen at. Now, the RBA wanted 4 pieces of data ahead of this meeting to decide on interest rates. We have them. Unemployment is at 3.5%. The monthly inflation read is at 6.8%. We had a mixed NAB business survey, but quite strong conditions in some areas and price pressures too. And the retail sales data for February has softened substantially, but it is clear consumers are still spending. So there's a lot to weigh up among the board members. We know Philip Lowe is typically a reluctant hiker, so he'll only do it if he is persuaded to do so and deems it necessary. Now, the markets are anticipating around a 15% chance of a rate rise today. That means just over an 84% chance that rates will stay on hold at 3.6%. Economists are a bit more split down the middle. Of 37 surveyed by Icon, 16 are expecting a hike to 3.85% today.
Peter Ryan outside the Reserve Bank in Sydney. To you now. Tell us a bit more then about what the Reserve Bank has to consider this month. What would make it pause? What would make it push rates up again?
Well, Ros, good afternoon. To think I was standing here back in April last year when the RBA's cash rate was 0.1%, you might as well say close to zero. A lot of people thinking that the Reserve Bank Governor, Philip Lowe, was probably right in saying that rates wouldn't rise until 2024, but we've seen that to be an ill-judged decision. But it appears that this is pretty finely balanced, as Alicia said. But when you look at inflation, 6.8% in the year to February, that's still incredibly high, way above the RBA's target band of 2 to 3%. Philip Lowe and the RBA board have said consistently that they want to do whatever it takes to rein inflation in. So it's still very high. It's got a long way to go. The question is whether or not the Reserve Bank thinks that 6.8% in the year to February, just down from December, is enough to confirm that inflation is falling. But will they really be wanting to take their foot off the inflation pedal and send that message that the inflation emergency is over, which might get people spending again and taking up bigger mortgages? So it's going to be a very finely balanced decision.
Yeah, we've got about a minute to go before we know what is happening on that. Why is inflation taking so long to come down after the number of rate rises we've had so far, Peter?
Well, it's a global factor, of course. It's a global issue. You look what's happening in the United States and Europe and other parts of the world. Inflation is only just starting to edge down. Demand is exceeding supply. You've got the war in Ukraine still going on. You've got the oil price on Brent crude getting up above $85 a barrel because OPEC's cutting supply, and that's going to be adding to inflation when that flows through to Bowser prices. So that's another complication for the Reserve Bank here today as well, Ros.
But we do still here have very high levels of household debt. You'd think that we'd be more sensitive to the cost of borrowing rising by so much.
Yeah, the issue is, Ros, that rate rises are a lagging indicator. We're only just seeing the impact of those 10 consecutive rate rises hitting. And of course, we've got that mortgage cliff coming later on in the year when those fixed rate mortgages start converting to variable. And that in itself is going to be a very, very hefty shock itself if you're thinking about blunt instruments of 10 consecutive rate rises.
Has the announcement.
Yeah, but home borrowers have a reprieve, a month of breathing space for now. The Reserve Bank has kept the cash rate on hold at 3.6%. So it certainly was something that was widely discussed and anticipated in some camps. It won't come as a surprise to those who are anticipating a rise would happen. I get the sense that there was very much a line ball call around even those who were predicting a hike, because this was so well flagged by the RBA Governor Philip Lowe as a possibility, which has materialised. So a bit of breathing space, I suppose, for those who have big mortgages and substantial repayments already after 10 rate rises in a row, but a pause for April.
What are economists thinking about it then?
Yeah, so economists haven't necessarily reacted so much, but certainly when we look at the dollar, that will be the biggest move. We do have Sherelle Murphy standing by, who is the chief economist with EY, so we will get her reaction. Sherelle Murphy, I suppose this wouldn't have come as a surprise. It could have gone either way today.
Certainly could. I think it was, as you say, a line ball call. And even the language in the statement does suggest that the Reserve Bank is far from relaxed about the inflation outlook and suggests that more rate hikes may be necessary down the track. So in the next month, we'll see some important indicators. Of course, the most important of these being the actual March quarter CPI itself. And that will give the bank a good indication of whether or not that sort of disinflation that it's starting to see in the monthly numbers is being verified in the quarterly numbers, and then what the path is likely to look like from there.
And you say it is likely we could see more interest rate increases. Can households handle more?
Certainly households are feeling the pinch, there is no doubt about it, and some more than others, particularly those who've taken out a mortgage recently or who have low savings. But across the economy as a whole, we know that savings buffer has been built up through the COVID lockdown period, with lots of government payments being fed into the household sector, and households, at least during that period, not spending quite as much. So in some ways that buffer is larger than normal. It's probably partly responsible for keeping the impact of monetary policy fairly muted in the first instance, and it's only really as the year goes on that we'll start to see the full impact of what was put in place last year.
And you mentioned those CPI figures. We will get them at the very end of April. That appears as though it's going to be the key determinant for the RBA, as well as, I guess, developments in the global economy, it says, especially after OPEC helped boost the oil price yesterday afternoon. That's not going to help inflation.
That's going to lift the headline inflation rate, there is no doubt. The central bank usually looks through these kind of movements, because just as quickly as they go up, they can sometimes come down. However, if that feeds through into petrol prices and feeds through into households' expectations of where inflation is going to be, and therefore can feed into wages, claims you're likely to see some, again, uncomfortable lift in inflation as a result. So it's certainly not welcome in this environment. And when inflation's already high, of course, anything that lifts it up a little bit further can be trouble.
And Sherelle Murphy, the board statement accompanying this says the board may well need to roll out further monetary tightening, as opposed to will be needed to ensure inflation comes down in the March statement. I mean, are we splitting hairs when we're talking about this kind of language, or do you think that's significant in the sense that this could be the end of it?
Look, the Reserve Bank has to leave itself some flexibility. It doesn't know what it's going to do next month because it hasn't seen the data as much as we haven't seen the data. So it does certainly have to leave itself some room. However, I would sort of characterise this as kind of a hawkish pause. In other words, it's pausing for now, but it's certainly not saying, relax, we're done. So again, I think the Reserve Bank is pleased that we are seeing some reprieve in those inflation numbers. The monthly indicators are good, but there's still a tight labour market. We still have higher oil prices, of course, as of the weekend. We still have input prices for business going up, and we still have a little bit of signal in the housing market that things have actually gone the wrong way, in the sense that housing prices went up in March. So I don't think the RBA will be relaxed by any means, but at least for the moment, it's happy to see how last year's rate hikes and those at the beginning of the year flow through to the real economy.
Okay, Cheryl Murphy, thank you so much for your time. So, Roz, as Cheryl says, a hawkish pause.
Yeah.
The RBA certainly not giving up on its fight against inflation yet, but a breather for those with home loans.
Let's go back to Peter Ryan, who's there at the Reserve and has been poring over the statement from the Reserve Bank, just an announcement that rates will stay on hold for this month. What's your sense about where things go from here? A hawkish pause, is that your view of what's going on?
Well, I liked what Cheryl Murphy referred to as that hawkish pause, because that's exactly what it is. It's a pause in April, but there's no guarantee at all that there won't be more rate rises down the track, and the Reserve Bank's language is pretty similar, saying that the board is resolute in doing whatever it takes to get inflation under control, because if they don't get it under control, it'll be much more costly to bring it down later on, more code for more interest rate rises. But really, the language around this is that the Reserve Bank wants to sit back, look and watch and see the impact of the 10 rate rises we've had so far, to assess the impact. And was made the point they're not saying that there will be more rate rise, but they expect there could be room for more rate rises if inflation doesn't go the way they want it. And those quarterly inflation figures that we'll be seeing on April the 26th will be key, because unlike the monthly inflation figures, they're looking at a much bigger and broader basket of goods that will tell us much more about the economy, what people are pulling back on, how concerned people are about rising mortgage repayments, the impact of the higher cost of living. And that could be the trigger for the Reserve Bank to easily look at that. If that comes in as a surprise rise in quarterly inflation, well, the Reserve Bank might be back to square one and having to push the cash rate up even higher then. But a pause today, but no one should be breathing too much of a sigh of relief, but no doubt there will be a lot of people out there feeling just a little bit more relaxed this afternoon.
Yeah, for now at least. What about wage pressures, Peter? Unemployment is so low. Are there signs that's pushing wages higher, which would be a problem for the Reserve?
Yeah, that's right. Look, any data that's coming in, any official data that's coming in is critical, but in particular wages. We still have wages data, creeping higher. We have the very tight labour force, employment figures, jobs, unemployment at close to a 50-year low. That's showing a very tight economy. Wage demands, we've got enterprise bargains being reviewed at the moment. Workers really pushing hard to get as much as they can in their pay packets to try to keep up with inflation. The Prime Minister, Anthony Albanese, said last week that he supports any move that would help households keep up with the rising cost of living. That doesn't mean 6.8%, but it means that wages are going to have to keep rising. That could, of course, add in, but we haven't seen any evidence so far of the much feared wage price spiral that we saw in the 1970s.
And Cheryl Murphy mentioned this also. The latest housing data, Peter, showed housing prices ticking up again despite the high interest rate climate. What is happening there?
Well, that's right. As much as I hate to use the term a perfect storm, that's what we're having at the moment. If you pause on rates at a time when you're seeing housing prices starting to tick up just a little bit after a bit of a correction, that could encourage people to go out and borrow more money, fuel housing prices. Of course, there's a rental crisis at the moment. Banking regulators will be very concerned to make sure that people don't borrow beyond their means. And of course, in the background, along with the rising oil price, we've got concerns about the fate of smaller banks in the United States that could trigger contagion, amid fears about perhaps a wider ticking time bomb of a banking crisis in the United States that could have ripples around the world. So while that wasn't mentioned in Philip Lowe's statement, surely that would have had some discussion at the boardroom meeting today here at Martin Place.
Back to you finally then, Alicia, how have the markets responded?
Well, whilst it wasn't a surprise to the markets whatsoever, because 84% of those in the financial markets had expected this pause, the Australian dollar has actually fallen around 1/3% to 67.64 US cents. The market itself, though, has picked up, perhaps after the move from the RBA to keep interest rates on hold. It was trading down a few points. It's now up a few points, so moves at the margins. But certainly there has been a reaction there on the market today, Ros.
OK, well, let's wrap things up there with a reminder that there's some relief for mortgage holders, with rates staying on hold at 3.6%. Thanks to our finance reporter Alicia Barry and to our senior business correspondent Peter Ryan at the Reserve Bank in Sydney. See you both same time next month.